ChatGPT has been making huge waves in the artificial intelligence space, but I think they're going to meet their match. Google has announced Bard yesterday, their own artificial intelligence, and now it's the battle of the AIs to see which one will reign supreme over the search engine space. In today's video, folks, we're going to find out what we should be paying for Google today, because this is some huge news. It's going to affect investors like you and I who potentially want to buy this company. But seeing their earnings over the last 4 quarters has been making me think otherwise. However, with Bard pretty much coming up the ranks, we will see how this affects this company. Stock price has been going up from $88 currently to now sitting at $106.64. The software I have loaded here, StockSpec software, is a great analysis tool that I use to really just get the information on this company incredibly quick and efficient. This company is ranked a 9 out of 10, which means they're doing a lot of things right over the last 5 years. They're only getting knocked in one section, and that's the price to earnings ratio over the last 5 years, sitting at 26.05. We like to find companies that are sitting at 22.5 and below. That is much more of a fair multiple to pay for those earnings, because ultimately, folks, as an investor, you are owning a part of a business. So how much you pay for that business goes a lot into your desired return and what you can potentially expect for the future. On this channel here, we're trying to find great companies for great prices. With the exception of the price earnings ratio sitting a little bit high, their current ratio and everything else that follows is looking pretty good. They have a lot of assets on hand to cover those liabilities. Their return on equity is extremely high, sitting at 21%, and their earnings per share has been growing over the last 5 years. These are all pluses. These are all phenomenal things you want to look for in a company. The debt to equity is low, and usually when you have a low debt to equity, folks, you can expect share dilution to be up, but not the case here with Google. As of the last 5 years, they have been buying back shares by 50%. Something that is probably one of my most favorite things to see on this board. Low debt to equity and a high buyback of shares. The net income is up, the free cash flow is up, the revenue growth is up, folks, and the return on invested capital is sitting at 19%, which is great. We want to see that above 10%, and we're well above that. Guys, Google is doing a lot of things right. Now, it wouldn't make sense for them not to have an AI software. They probably knew this day was coming. So what does that mean? How do we price this in? Well, honestly, guys, if you've been following the channel, you know that I'm a pretty conservative investor. And honestly, I'm not going to break away from those principles. If I take a conservative approach with this business, which I've done in the price analysis section here of the software, I can at least give myself a huge margin of safety. Because here's the thing, folks. Let's say Bard, for whatever reason, it just crashes and burns. Is that going to affect the valuation of the business? Well, quite possibly, but there's obviously other forms of revenue that Google has. So what I'm trying to factor in, folks, is from a conservative basis, and I'm hoping, what I am trying to hope for, folks, is that they beat these numbers here. So that's why I did 5, 6, and 7% revenue growth, profit margin pretty much the same as they've expressed over the last 10 years, but mainly my evaluation is coming from this low revenue growth numbers going forward, because you have to also think about this, folks. It is a $1.35 trillion company. Can't expect this company to be growing that much. However, we're going to uncharted territory with this AI stuff. Price to free cash flow and price to earnings ratio sitting at a very conservative number of 14, 16, and 18. Desired return, 13%. Hit the calculate button. It's going to spit out a number that we should be paying for this business today. So if you want to get your hands on the software, guys, by all means, follow the links in the description box below. And if you're enjoying the video, hit that like button and subscribe button. This software here calculates everything. It's a one-stop shop, and you have 10 years of financial data. We're just scratching the surface. And take a look at that, guys. Take a look at that. $107 is what the current price is today, and the average calculation comes out to be $205. That means Google is undervalued by at least $100, and it is a screaming deal today. And this is me trying to be as conservative as possible, not factoring in a huge increase from Bard, but that very well could be a huge factor going forward. Let's go with a lower revenue growth. Let's see how conservative we can potentially get going 3, 4, and 5, and see what that comes out to be. calculate. So yeah, average calculation, it's still going to be in that undervalued territory, but look at that. 3% revenue growth. I'm looking at my conservative category here of 135. That's looking pretty good. That's looking pretty good. And let's say Bard just blows ChatGPT out of the water. You can probably expect a lot more. So this is why it's imperative, folks, to have those conservative metrics going forward, because look, if you're wrong in the sense that they beat those numbers, you're gonna win. And let's say everything flops. Let's say Bard is a huge failure and the revenue growth just grows extremely slow. Well, and you're right on these numbers. Look, you're still getting this company at a great deal. Anyways, folks, if you found this video helpful, hit that like button, share it with a friend, because I'm going to start covering Google a lot more, because now things are going to get a lot more interesting due to the fact that now we're hitting this AI space. And we're going to see how their search engine gets affected by all of this. But yeah, super exciting. Just want to make this brief little video to say that, hey, right now, even with Bard not even out, it's pretty much an undervalued company. So take that what you will, and I will see you in the next video. Thank you so much for watching. If you enjoyed this video, make sure you don't miss out on this stock right here. Now, I believe this might be the potentially best investment going forward in 2023, given everything that's happening.